What's up, YouTube? Welcome to Wise Wealth, where we discuss everything personal finance. Whether you're looking at ways to save more or to generate additional income streams, we explore methods to achieve all of this, setting you on your path to financial freedom. If you'd like to hear more, don't forget to subscribe and hit the bell icon to make sure you're notified of any new content. Without further ado, let's get into today's video. Today we'll be exploring 3 ways to generate passive income. This is income generated through assets, without you having to dedicate your time to earn. Always remember that money is a resource that we can gain, but time is finite for everyone. This could be used to supplement your primary income from a day job, or if done correctly and on a large enough scale, could be sufficient to live off. What's great about all of these methods is they require little or no intervention on your part. You can guarantee the income that you receive from them, as well as have the money that you invested appreciate over time, and in some cases, this capital gains can be a significant rise. I must caveat this video by saying that this is not financial advice and is purely for informational purposes. The first method that we'll look at is through dividends. How can we earn dividends? Simple. Through purchasing shares of a company on the stock market. By doing this, you are effectively owning a portion of that company, albeit a small one. On a periodic basis, which could be monthly, quarterly, biannually, or annually, listed companies will distribute some of their profits to all of their shareholders in the form of dividends. What's great about this is that once you purchase shares within a company, there is no intervention required on your part whatsoever to generate an income, and it immediately adds an additional revenue stream. Researchers have shown that the average millionaire has 7 different income streams. So long as you hold an investment in the company and it pays out a dividend, you will make money off it. So in theory, if you hold an investment for long enough, the dividend payouts you receive can match and exceed the value of your initial investment. In addition to this, you retain that initial capital value that you invested, which most likely increased over time the duration you hold it. Historically, investments in the stock market over the long run have yielded significant capital gains. While past performance isn't necessarily a guarantee of what you will have in the future, there is a lot of value in understanding the cause and effect relationships that occur when investing to make sure you're aware of what could happen in the market. This is why investing in the stock market is such a powerful tool for building wealth. If the company does well and increases its earnings over time, the price of your shares can increase, giving you that capital appreciation on your investment. Conversely, if the company's performance is on a downward trajectory, the share price can fall and thus giving you a loss on your investment. It's worth mentioning that company performance can be inhibited by both internal challenges that they face, but also several other variables such as macroeconomic factors, geopolitical tensions, and restrictions on trade. This is why trading platforms or institutional investors warn individuals that their capital is at risk should they decide to invest. Always be mindful that your investment can go down in value as well as up. But that's not why we're here today. As an investor looking to generate a stable revenue stream over time, we're most interested in stocks that provide high dividend payouts. And there are many ways that we can spot this in a company before we invest, and that's done by looking at their financial data. One way to determine how much dividend a company will pay out is pretty simple, by looking at previous year's dividends. How much did they pay out, if at all? This is an essential indicator of whether you will receive a steady stream of income. For example, if you take Royal Dutch Shell, this company has managed to deliver an uninterrupted stream of dividend payouts since World War II. Signs like this can give investors confidence that dividends are unlikely to be cut or suspended in the near future, with the exception of unprecedented circumstances. Another factor to look at when looking for an income stock is the dividend yield. This is taken by dividing the dividend payout by the share price to give a percentage yield. While this is a useful tool for calculating an expected dividend, this should not be taken at face value while ignoring all other variables. While a high-yielding stock can indicate that a company pays out an attractive dividend, it can also suggest that the company is facing challenges. Taking the example of Shell again, in the last month, the dividend yield was set at 15%. At a first glance, this looks very attractive. However, looking into it further, this was due to the massive crash in oil prices in the recent months, leading to a significant sell-off of the stock. Researching the industry a company operates in can sometimes uncover information you as an investor would benefit from. In the case of Shell, as a behemoth of the oil and gas industry with billions of pounds in operating profit each year, it has a robust balance sheet that is fit to sustain the turbulent conditions of the current market, and it could be seen as an attractive prospect, which is why it's on my personal list of upcoming investments to look at further. Another example of where dividend yield may not be reliable is with the example of Into Property Group. Their current dividend is set at 117%. This is because of the amount of debt obligations that the firm is required to pay, with the current management team in crisis talks over a recovery after a potential acquisition recently fell through. Personally, I think I'll be staying away from that one. Now, there are other factors to take into consideration when looking for a dividend stock, and this is a video in and of itself that I'm looking to do in the future. Let me know in the comments if this is something that you would like to see. Similar in nature to dividend payouts is the passive income generated by funds. Rather than investing in a single company as you would do to receive a dividend, these pool together investor money to form a fund. These funds are comprised of holdings in many companies across many industries. Instead of investing in all of these companies individually, you're effectively spreading your investment across the entire fund and all the shares within it. Why is this a good thing? Well, as an investor, you're not exposed to the volatility of a single company, and your investment is significantly diversified. This lowers your risk and ensures your capital is secured against a single company's sudden fall in value, should that occur. On the flip side, if a single company in the fund were to suddenly double in value, you would realize less of a gain than if you had invested solely in that company. Investing tends to offer a risk-reward payoff. How and where you invest is dependent on the amount of risk you want to take on. In the recent market downturn, where shares saw a fall in value of approximately 30% and in some cases more, there were many funds that recorded losses of only 15 to 18%, with a significant fall in shares offset by more stable ones. Diversification is essential to achieving a balanced portfolio that can weather turbulent conditions, and funds provide part of this to an investor. Ray Dalio, the founder of the largest hedge fund in the world, Bridgewater Associates, explains the principle of diversification as the holy grail of investing. In a nutshell, he suggests that diversification allows investors to achieve the high returns they desire while lowering the associated risk. He was also the creator of the All-Weather Fund, which gained popularity throughout the industry as a mechanism to maintain stability in capital throughout all environments. This is also now known as achieving risk parity. A key difference in funds to holding individual shares is that funds are managed by a third party. They ensure the fund maintains a predefined balance in its investments and can differ in nature. Some funds are geared towards the growth of the stock and seek capital appreciation, while others are high income earners geared towards shares that, once again, pay out high dividends. As a result of the ongoing management of the fund, in some cases there is a cost incurred. A management fee will be deducted from the holdings, typically on an annual basis. It is important to look at this before investing, as funds can incur a hefty management fee. Personal favourites of mine include the iShares Core FTSE 100, which tracks FTSE 100 companies at a very low cost of 0.07% per year. Another is the HSBC MSCI World Fund, which spans over 1,500 companies in 23 different countries at 0.15% per year. Diversification can be achieved by not only investing in multiple companies, but also across different geographical markets. A downturn in one region can be countered by stability or increased productivity in another. Additionally, the conversion of foreign currencies into your local currencies and vice versa can provide an added level of diversification. If you are new to investing and are looking to jump in, funds offer an easy and hassle-free way of starting off your investment journey. You'll get a feel for what it's like to have capital invested in equities while a professional manages the entire process for you. The third and final method in this video is generating passive income through real estate. Unlike the first two methods, real estate is a tangible asset. You can see it, live in it, and rent it out to other tenants for income. Property is considered one of the safest investments, as it always appreciates over time. Having a rental property, or multiple, in your portfolio is highly desirable. Housing will always be in high demand, and there are plenty of prospective tenants to occupy your property. However, investing in a rental property does come with some barriers. Firstly, you'll need a larger lump sum of money to invest in real estate than in shares or funds. This will be used to put down your deposit. Additionally, in the UK, a buy-to-let property or secondary properties other than your main residence incur a stamp duty surcharge, further increasing the initial investment required. You'll also need to have a good idea of what the approximate housing prices are in the area you're looking to invest in to ensure that you get a good deal. This can vary due to many factors, primarily location, proximity to major cities, public transport, schools, and much more. Local estate agents are great for this as they have invaluable knowledge of the local area. Browsing property portals such as Rightmove or Zoopla are also great ways to become more familiar with surrounding areas. Like shares, there are several calculations investors should weigh up before committing to a rental property. The first is the expected rental yield. By taking the estimated rental value, or ERV, and dividing it by the house price to give a percentage yield. The higher the yield, the more attractive the rental prospect. Similar to dividend yields, this should not be taken alone, and other variables should be considered. Another calculation is the return on investment, or ROI. This should always be taken into consideration before investing in property. This is calculated by taking the estimated net profit of owning and renting the property and dividing it by the total investment made into the property. This total investment should include all investment, from the deposit to stamp duty to mortgage fees, furnishing, and anything else. The higher the ROI, the better the investment. Knowing what your costs are before investing and budgeting it accordingly is essential to investing in real estate. If the property cash flows negatively, meaning the costs incurred are greater than the revenue it generates through renting it, then your disposable income will decrease as a result of owning the property, and you would have been better off not investing in it at all if passive income generation was the objective in the first place. Another element to be mindful of is that rental properties can go through void periods. This is when there is no tenant living in the property and you are subsequently not generating any income off it. You will, however, still incur the cost of owning the property, such as mortgage fees and any overheads. Estimating a void period between tenants and factoring this into your calculations can help you envisage what your projected cash flows may look like. Managing the process of looking for prospective tenants, interviewing them, screening and moving them in can be time-consuming. If you want to take a more hands-off approach to owning real estate, you can onboard a property manager to do this for you. They will manage the property, any maintenance, and the tenants for a management fee. This takes pressure off you, but will also lower your margins. And there you have it, 3 ways to earn passive income. Thanks for tuning in. If you're enjoying the content or would like to see more, hit the like button to let me know. Also be sure to leave a comment below on any topics you would like to discuss. Remember to subscribe if you haven't already, and until next time, see ya.